morning, everyone. Thank you for attending today. I'm Mark Griswold, International Senior Manager in Boulder, Colorado, and with me is Chris Stroh, who is a Senior Manager in our international team located in Denver. And our topic today that we want to talk about is tax export incentives, primarily related to what's called the IC-DISC and Foreign Derived Intangible Income, or FDII. So I'll start with talking about the IC-DISC. We'll go over the benefits of that and some ownership structures. We'll talk about the requirements and go into some detail on commission calculations. And then Chris will come in with the FDII topic. So to start off, who can benefit from an IC-DISC? You'll hear a lot of times people talk about manufacturers with IC-DISC. The reality is that IC-DISC can be used in industries just beyond manufacturing. So for example, the agricultural industry, the mining industry can benefit from an IC-DISC for property that they grow or produce or extract from the US and export. And you can also get a benefit if you are an architecture or engineering service provider who provides service for construction projects that are located outside the US. So there's really a lot of industries that can benefit from the IC-DISC. The key point is it has to be something that's produced within the US that is sold for export. There are two types of IC-DISC. The most common type is one that's called the commission disc, and pretty much all of our discussion today will be about the commission disc. The commission disc is, for the most part, just a paper entity that has no substance. The only asset it really has is a bank account that can receive a commission. That commission would be based on the qualified export receipts of the manufacturer, and then the commission disc will pay that commission out to its shareholders in the form of a dividend. But the commission disc is largely an invisible entity with respect to the manufacturing company's customers. The commission disc doesn't receive title to any property, and the customers don't really know it exists or have reason to know it exists. The second type of IC-DISC is what's called a buy-sell disc. This disc is not very often used, but the difference is that it will actually receive title to the export property and will be the seller of record when you export. So why would you want to use an IC-DISC? The primary benefit you get from an IC-DISC is that you can achieve permanent tax savings. And how this is achieved looks a little bit different between a pass-through entity and a C corporation. For a pass-through entity, you are basically shifting ordinary income to qualified dividend income. And the tax savings is going to depend largely on the tax rate that the individual taxpayer is in for both their ordinary income and for capital gain income. But if you assume you're in the highest tax bracket, you would achieve a 5.8% tax savings. And that's based on a 29.6% effective ordinary tax rate if you are in the 37% marginal rate adjusted for the Section 199A deduction, compared to a 23.8% capital gain tax rate, assuming 20% capital gain rate plus the 3.8% net investment income tax. For a C corporation, your tax savings is basically through the avoidance of double taxation on the IC-DISC commission. So you're able to get earnings out of the C corporation in the form of the IC-DISC commission and receive the expense at the C Corp level. And so that can get you about a 16% tax savings. Another benefit of an IC-DISC is you can actually defer income tax by using an IC-DISC. And we'll talk about the deferral a little bit later on in the presentation. But one thing to note is that if you defer income tax, you have to pay an interest charge on that. And that's where you get the interest charge part of the IC-DISC name. So to look at a couple ownership structures, in a pass-through entity example, we would generally set the IC-DISC up to be a subsidiary corporation to the operating company. So as you can see here, we would pay a commission from the operating company down to the IC-DISC sub. The operating company would receive an expense towards taxable income for that commission payment. The IC-DISC, as long as it has a valid election in place with the IRS, is a federal tax exempt entity. So the IC-DISC does not pay any income tax on that commission it receives. And then it can distribute that commission it received back to the shareholder, in this case, the operating company, as a qualified dividend. So you achieve two things from this. One, you have this circular payment. The cash goes from the operating company to the IC-DISC and back into the operating company. And so as a result, the cash ultimately will stay in the operating company and can be used for whatever purpose you need to use that cash for in the business. And the second thing is on the K-1 that the operating company would issue to its shareholder or partner, you have basically shifted income from the ordinary income line to the qualified dividend income line, which then once you get to the individual taxpayer's return would be taxed at the reduced rate. So let's look at an example of the flow-through, pass-through entity with some numbers here. So on the left column, we assume we do not have an IC-DISC. We would have, for this example, $100,000 of net income. We receive that pass-through deduction, the Section 199A deduction of 20%. So that gives us adjusted taxable income of $80,000. And that would be taxed, assuming the highest marginal rate, 37%, the total tax would be $29,600. Now, if we were to add an IC-DISC to this structure, and for this example, we'll assume our IC-DISC receives a commission of $10,000. So now our taxable income is reduced to $90,000, and our adjusted taxable income after the pass-through deduction is $72,000. At 37% tax, our tax is $26,640. But now we receive that dividend of the commission of $10,000, subject to tax at 23.8%. Again, assuming we're subject to net investment income tax. So $2,380 is the tax we pay on the dividend. $29,020 is the total tax we pay. So our tax has been reduced by $580 in this example as a result of implementing an IC-DISC in the structure. Or you could look at that as being 5.8% of the commission amount. There's been some talk of potential rate changes coming. This seems to be a very fluid situation by the day and by the hour. So it's really kind of up in the air as to what would happen. But some of the proposals that have been thrown out was that the individual rate would increase to 39.6%, and the dividend rate would increase by 5% to 28.8% with the net investment income tax. And so you can see if we were to adjust our example with those proposed rates, our tax savings actually would be cut in half. So we would get roughly a 2.9% tax savings on the commission amount. So a little bit less of a savings than we would get under current rates, but there's still a tax savings to be had. So let's look at a C-Corp structure. If our operating company is a C-Corp, the C-Corp doesn't get the benefit of reduced capital gain tax rates like an individual does. So because of that, it doesn't really make sense to set the IC-DISC up as a subsidiary to a C-Corp operating company. Instead, you would want to have that IC-DISC directly owned by the shareholders of the operating company. And so in this case, the operating company pays the commission out to the IC-DISC like we had in our prior example. It receives an expense for that and gets that tax benefit for that commission payment. The IC-DISC then distributes that out to the shareholders. The shareholders are subject to qualified dividend income, capital gain tax rate. And in this example, we have now avoided the double taxation that you would normally get with a C corporation because the earnings have gotten out to the shareholder but the C-Corp has been able to deduct effectively that distribution through the form of the commission payment, as opposed to if the C-Corp were to just distribute profits without the commission, it can't take a deduction for that dividend payment. A drawback, though, is that cash is now outside of the corporation. So if you want to leave that cash in the corporation for operating purposes, the shareholder would need to loan or recontribute that cash to put it back into the corp. And an example with some numbers for the corporate example. So again, we'll assume $100,000 of taxable income, 21% corporate tax, so 21,000 would be our tax at the corporate level. They would distribute the net proceeds, 79,000, out to the shareholders at 23.8% tax, so 18,802 would be the tax the shareholder pays on the dividend income, resulting in total tax of 39,802. Now we add the IC disc to the structure in the right column. Again, we'll assume a $10,000 commission, so that gives us 90,000 taxable income, or 18,900 of tax at 21%. We have 16,922 of tax on the dividend of the net profits out of the corporation. And then the shareholder also has to pick up the 10,000 IC disc commission as a dividend. For 2,380 would be the tax on the IC disc dividend. So total tax would be 38,202, which is a $1,600 savings over not having an IC disc in the structure. So that's where we get the 16% tax savings, because our 1,600 of tax savings divided by the 10,000 commission is 16%. And if we look at a corporate example with the proposed tax rates, again, maybe it's not likely that corporate rates will go up, but there's been talk of them potentially going to 26.5%. So in this example, you'll see our tax savings would go from the 1,600 to 1,887, or give or take 19% of our commission amount. And again, the realized tax savings is going to depend on the marginal tax rate that you are in for both ordinary income, capital gain income, and then whether or not you're subject to the net investment income tax. Okay, so let's talk about what are the requirements to be an IC disc, to set up an IC disc, and to use the IC disc. So there's three key requirements. One is you have to be an eligible corporation, and that is the IC disc has to be an eligible corporation. Two, you have to meet what's called a qualified export receipt requirement. And lastly, you have to meet what's called a qualified asset requirement. So starting with the eligible corporation requirement. The IC disc has to be a separate legal entity. So you have to set up what's called an eligible corporation, which is basically just a C corporation. And that corporation has to be incorporated in any of the US states or District of Columbia. It can only have one class of stock that it issues, and that has to be a minimum of $2,500 par or stated value. The IC disc entity has to maintain separate books and records apart from the operating company. And most importantly, the IC disc has to timely file an election with the IRS to be treated as an IC disc, and that's filed on IRS form 4876-A. The election is due 90 days after the date the IC disc corporation is created. And that due date is important to note because you can file the election late, but the only way to do that is through a private letter ruling. And the user fee for a private letter ruling can get fairly expensive. So it's best to just get the election in as soon as you can. Because the IC disc is a separate legal entity, it's also required to file an annual tax return. That return is filed on Form 1120 IC disc. And also to note with the IC disc that there is no retroactive benefit. So the benefit will start on the date of incorporation and can be achieved from that date going forward. So if you were to set one up today, any sale that you have that qualifies from today through the end of the year can be used for the IC disc, but any sale that occurred before today, from the beginning of the year until yesterday, all of those sales cannot be used for the IC disc. And so for that reason, if you are looking to set up an IC disc, it's best to get it set up as close to the beginning of the year as possible in order to maximize the benefit for that initial year. So the gross receipt requirement says that 95% of the gross receipts of the IC disc have to be qualified export receipts. The main gross receipt you'll see in an IC disc is the commission, and that commission is calculated based on the sale of qualified export property. And qualified export property is a key term that's defined in the Treasury regs, and it's key because without qualified export property, you really can't use the IC disc. So qualified export property is achieved by meeting 3 tests. You have what's called the manufacturing test, the destination test, and the fair market value test. And if you meet all 3 of those tests, the sale of that property is considered qualified export property, and you can calculate a commission off of that sale to be used for the IC disc. The manufacturing test, simply stated, is that property has to be manufactured, produced, grown, extracted in the US by a person other than a disc. And you'll commonly hear the manufacturing company or the operating company, the one that's doing the work to generate the qualified sale. You'll generally hear them referred to as the related supplier in the IC disc world. So the manufacturing test can be achieved really in 2 different ways. One is substantial transformation. So you are taking a raw material and transforming it into a finished good. The Treasury regs give some examples, such as you convert steel rods into bolts, or you convert wood pulp into paper. The main thing is you're taking something, substantially transforming it into something else. And note, for this purpose, packaging and assembly does not count as substantial transformation. The other way to achieve manufacturing in the US is you add value to property. And in this case, you can use packaging and assembly. And really, to add value, you have to have a 20% conversion cost that takes place in the US. So you are improving upon an existing product. So for example, let's say you buy t-shirts that are plain and you add some sort of printing or graphic to that plain t-shirt. As long as you are adding 20% through cost of labor or additional materials to the final product, then you would achieve the value added property and would meet the manufacturing test. The second test, the destination test, states property must be held for sale for direct use outside the US. And for IC disc purposes, the US definition includes its territories. So any sale to a US territory is not a qualified sale for IC disc purposes. The destination test can be met in really, again, in 2 ways. One, you directly sell outside the US. So you are selling to your direct foreign customer, you are exporting to that customer, or you are delivering to a freight forwarder of the customer who then does the export. Or you have a direct sale within the US in which that property then is ultimately delivered or used outside the US within 1 year of the original sale. So for example, US manufacturers sell to a distributor. That distributor is located in the US, and that distributor then sells to a foreign customer and exports the property. The manufacturer in this case can use that sale to the distributor for ICDIS purposes, as long as the sale from the distributor to the customer, the export, takes place within 1 year. Another example is maybe you sell to a US customer, and that US customer tells you that they are gonna use the property in a foreign location. And so as long as they export the property, the customer exports the property within 1 year of sale, then you can include your sale to the US customer in the ICDIS calculation. A drawback though is that property cannot be used or further manufactured in the US prior to its export. So in the example of selling it to a US customer who's going to ultimately use the property outside the US, let's say they have some sort of use of that property in the US before they export. If that were to happen, then that would cause the manufacturer's sale to the customer to fail the destination test, because that property had been used in the US prior to its export. Another example could be you sell a product to a US customer who then further manufactures that product into a second product, and then that person exports that property. The sale from the original manufacturer to the second manufacturer in the US now would not qualify for the ICDIS purpose. However, the subsequent sale from the second manufacturer to the export could qualify, assuming they meet the manufacturing and the fair market value test. The other thing is there's a proof of compliance, and the burden is with the seller on the proof of compliance. So if the IRS were to audit the ICDIS, they will want to see proof that the property was in fact exported. And if you can't provide that proof, then the sale will fail the destination test and cannot be used for the ICDIS. So this is really a key thing if the manufacturer, the one who wants to claim the ICDIS, is not the actual exporter. If they are not the exporter, but know that the property is being exported and want to use it in the ICDIS, you would need to talk to your customer or whoever actually does the exporting to try to obtain the export documentation so that you have that on file to prove compliance if it were ever requested by the IRS. There's a few items under the Treasury regs where even though you export property, the property will be deemed to be used in the US. This generally happens if property is re-imported back into the US within 3 years of the sale. And that could be maybe the property is re-imported as is back into the US, or that property was used as a component in a second product, and that second product is sold into the US within 3 years of when you sold the original property for export. There's also a reasonable person test. If you have any reason to believe that the buyer will use the property in the US, or you have an understanding with the buyer at the time of sale that that property would be used in the US, then that property is deemed to be used in the US. There are some exceptions to this. For example, if you're selling to a retailer located outside the US, then that is deemed to be used outside the US. So if you sell to, say, a tourist store that's located on the US border in Canada, and someone is in Canada and they buy something there and bring it into the US, because you sold it to a foreign retailer, that property has now been used outside the US. Also, if you have a component part that gets incorporated into a second product, If that second product is sold on a worldwide market, then that property is deemed to be used outside the US. So let's say you manufacture a water valve in the US and you sell that to a foreign manufacturer who then incorporates that water valve into a washing machine. It could very well be that some of those washing machines get imported into the US and sold within the US. But if that machine is available for sale on a worldwide market, then your original sale of the water valve to the foreign manufacturer would qualify. The last of the three tests is the fair market value test. It says that no more than 50% of the fair market value of export property can be attributed to imported materials. And for this purpose, fair market value of export property is deemed to be the sales price of that property to an unrelated customer. So if we go back to that t-shirt example we used in the manufacturing test, if that plain t-shirt that you're using to add the graphics to was made outside the US, and let's say you bought that shirt for $5, you do your graphic adding to it, and then you sell the improved t-shirt for $20 to a customer. So you take the $5, which was the imported value of the shirt, and divide it by $20, which is your sales price to your customer, that's 25%. And since that is less than 50%, we would meet the fair market value test, and that sale would qualify for IC disc as long as you also meet the destination and manufacturing test. So those three tests, if you meet all of those tests, then the sale of that property can be included in your IC disc. You can calculate a commission on that. The last requirement, we talked about the eligible corporation and the qualified receipts. The last requirement is the qualified asset requirement. So 95% of the IC disc assets have to be qualified assets. There's a list here of some common qualified assets, but the assets that you'll typically see on an IC disc balance sheet is your cash account and then a commission receivable. The commission receivable is what you accrue at the end of the year because the commission is typically determined following the close of the tax year. And so that'll be your largest asset, and for the most part, your only real qualified asset. Cash by itself is not a qualified asset to the extent that it's not needed for working capital. And because an IC disc really doesn't have any expenses, there's no reason to really accumulate cash in an IC disc. So if you were to accumulate cash in an IC disc, then you would run the risk of failing the 95% qualified asset test. This test only needs to be met on the last day of the tax year. So theoretically, you can fail this test for 364 days, but on the 365th day, the last day, you need to make sure you meet this test. Okay, so we talked about the requirements of the IC disc, kind of the benefits of the IC disc, and throughout that conversation, there has been a lot of talk about the commission. And the commission calculation is really what derives the benefit of the IC disc, because the greater your commission is, the greater your tax savings will be. So a lot of the science in the IC disc is in calculating what this commission amount will be. The Treasury regs give 3 acceptable methods to calculate the commission. These are taking 50% of what's called combined taxable income, 4% of your gross export receipt, or you can use a marginal costing approach, which is more or less an alternative way to calculate combined taxable income. There is what's called a no loss rule. The no loss rule means that your commission cannot exceed your combined taxable income. So if you are operating at a loss, that generally means you're not going to be able to benefit from a commission or calculate a commission. You generally need to have a profitable entity, a profitable manufacturing company, to be able to calculate a commission. There is an exception to the no loss rule. This is called the special 4% rule, which uses the marginal costing combined taxable income to calculate that. So combined taxable income, simply stated, is you take your qualified export sale, subtract out your export cost of sale, and then subtract an allocation of SG&A costs. The SG&A costs, you can divide those into 3 buckets. Your directly attributed to export, directly attributed to non-export, and then non-identifiable costs, which are attributed to both export and non-export. And then you would ratably allocate those non-specific costs towards your export sales. And then your end result is your combined taxable income. So effectively, it is your net income on the export sale. The IC-DISC commission is calculated on what's called a transaction by transaction method. So you calculate the commission on each individual transaction, and you can take the greater of the 4%, the 50%, or the marginal costing commission. And so the ability to do this on a per transaction basis really gives you the power to maximize your commission to the fullest extent possible. You do have the ability to group transactions by a series of products or product lines for the purpose of calculating the commission, and sometimes that can give you a greater commission, but there's really a lot of power into how you want to calculate the commission through grouping of products to try to ultimately maximize the commission. And by maximizing your commission, you're maximizing your tax savings. The marginal costing method, as I mentioned, is an alternative way to calculate your combined taxable income. The marginal costing, CTI, is the lesser of your marginal profit, which is just your gross receipts less your cost of sales, or your gross receipts multiplied by what's called an overall profit percentage, which is generally the taxable income of the related supplier divided by the gross receipts of the related supplier. Once you have your combined taxable income calculated under the marginal costing method, your commission would be 50% of that marginal costing CTI. So let's look at an example of the calculation. We have 4 transactions here. Each transaction is $1,000, and we'll assume our overall profit percentage is 10%. In the first transaction, we have allocated $200 of cost of sales, $500 of SG&A. So our combined taxable income is $300. Again, our overall profit percentage is 10%. So our 10% OPP multiplied by $1,000 gross receipts gives us an OPP profit of $100. So under the 50% of CTI method, our commission is $150, which is the $300 CTI multiplied by 50%. Under the 4% method, our commission would be $40, which is just our $1,000 gross receipt multiplied by 4%. Under the marginal costing method, our commission would be $50. So marginal costing, we take the lesser of our gross profit, which is $800, or our OPP profit, which is $100. Since the 100 is the lesser of the 2 amounts, we multiply that by 50%, and that gives us the $50 commission. So our best method in transaction 1 is the 50% method, and we would take a commission of $150 on that transaction. Going to transaction 2, we have $50 of CTI. So our 50% method commission would be $25. Our 4% method commission is still 40. And then our marginal costing would be 35. So in this example, our gross profit is only $70. And because that's lower than our OPP profit, we use the $70 as the combined taxable income under the marginal costing method. And so our commission is 50% of that, or $35. So the best method here would be the 4% method, and we would take a commission of $40. Moving to the third transaction, we have combined taxable income of $80. So we get a $40 commission under both the 50% and the 4% method. But now the marginal costing method gives us a $50 commission, because we take that $100 OPP profit times 50% to give us $50. So that will be our commission on transaction 3. And when we go to transaction 4, we now have a negative CTI. So this is when the no loss rule comes into play. We can't take a commission under either the 50% or the 4% method, but we still have the marginal costing method available. And so our marginal costing method will give us $25. However, the special 4% comes into play here because the $40 is less than our marginal costing combined taxable income. And so we can take the $40 commission under the special 4% method. So when we add all 4 of these up, our total commission is $280. Now, if we were to group all these transactions on the far right column, our commission would only be $200 as calculated under the marginal costing method. So this shows how you have the ability to increase your commission by calculating it on a per transaction method. And in this result, we are increasing our commission by 40% from 200 to 280. So as I mentioned, the IC-DISC commission has to be calculated based on taxable income, and your taxable income isn't going to be known until after the year end comes to a close. So an estimated commission is required to be paid into the IC-DISC within 60 days after the end of the year. And there is a reasonable estimate safe harbor rule of 50%. As long as you pay them 50% of the actual commission, you would be deemed to have paid in the estimated commission, as long as that's paid within the 60-day rule. But you probably don't have taxable income even within 60 days after year end. And so it might be July, August before you know your taxable income and before you know that final commission amount. So if you underpaid the commission by February, then you have what's called the 90-day commission, which is the true-up payment that you have to make within 90 days of the date that you determine what that amount is. And then the combination of your 60-day commission and your 90-day commission would equal your final total commission. If you don't meet the payment deadlines, then the commission receivable is not considered a qualified asset, and that probably will disqualify the DISC depending on what other assets you have in the DISC. So it's important to meet the payment deadlines for the IC-DISC commission so that you don't inadvertently disqualify the IC-DISC. And even if you do disqualify the IC-DISC, you have there's relief in the form of what's called a deficiency distribution, where you can then requalify the DISC. The other benefit I talked about is tax deferral with an IC-DISC. So there's no requirement that you actually have to distribute the accumulated earnings of the IC-DISC. And if you don't distribute the earnings, then there's no dividend income to the IC-DISC shareholder. There are some limitations to the deferral though. You have to make sure you meet the qualified asset test at the end of the year. The deferral is limited to commissions calculated on the first $10 million of qualified export sales. And then there's other items that can cause what's called a deemed dividend. And deemed dividends are taxed immediately to the shareholder, regardless of whether they actually receive a distribution. So to meet the qualified asset test, you have to plan that carefully because you don't want to inadvertently disqualify the DISC. So effectively, you need to convert cash into a qualified asset. And some common ways to do that is you can factor accounts receivable related to your qualified export sales. You can buy PEFCO papers, which are export bonds, or you can make a loan back to your manufacturing company in the form of what's called a producer loan. But if you do all these things, you need to make sure you follow the rules closely in order for that asset of the IC DISC to be considered a qualified asset. And then, as mentioned, interest charge will apply to any deferred tax. The interest charge is calculated based on the Treasury T-bill rate, which is published typically in the fourth quarter of the year. And the last thing I want to mention on IC DISC is that it's a federal tax incentive, and not all states will follow the federal treatment. Some states will tax the IC DISC as if it was just a normal corporation. Some other states might disallow the commission deduction, which would then increase your state tax. The state tax issues can get rather complicated, and a lot of states are silent on the matter. So really the bottom line here is if you want to implement an IC DISC, you should look at state tax issues and give thought to that in the IC DISC setup process. And with that, I will hand it over to Chris to talk about FDII.
Thank you, Mark. I appreciate that thorough discussion of the IC DISC as our first export incentive that we're discussing today. The second export incentive we are discussing today is FDII, which stands for Foreign Derived Intangible Income. This export incentive was put in place with the tax reform that happened in 2017, primarily as a means of incentivizing U.S. producers to keep their intangible assets onshore in the U.S. as opposed to putting them in a foreign jurisdiction. And we'll discuss a little bit about how we compute the FDII deduction and who is eligible for that as we go forward in the last 15 minutes here. I will start by saying it is quite a bit simpler than an IC DISC in its implementation, and certainly not as stringent in a lot of the rules that are promulgated under the code here. So generally speaking, taking a step back, the big picture is we introduced a new section 250 into the Internal Revenue Code, discussing the implementation of FDII in addition to another deduction which is eligible for corporations. As you can see here, it does create effectively a preferential tax rate for income for corporations who are what we're calling serving foreign markets. And that means either selling into those markets goods and or services for that matter. The effective rate that a corporation pays under the current regime of 21% top tax rate for corporations would be an effective rate of 13 1/8 after the deduction for FDII is factored in. And as mentioned several times, really only C corporations are eligible for the deduction. In many instances, a partnership could be operating and offering sales and services outside the U.S., which would be eligible for an FDII deduction, to a corporate partner, is how that would effectively work. As a brief overview of FDII and how it works, or FDII, we'll sometimes call it, Section 250A allows this domestic corporation to deduct what is basically 37.5% of its determined foreign derived intangible income. And you'll note we also added, because Section 250 is broader than just FDII, it also allows 50% of its deduction against guilty income included in its gross income. a bit beyond the scope of this discussion for guilty purposes here, as this is focusing just on U.S. export incentives. It's important also to note that any deduction that is generated through FDII can also be reduced when the sum of its FDII computed exceed its taxable income, and we'll walk through an example of that later, just to demonstrate how the deduction is sort of haircut when there's not enough taxable income. You won't get FDII driving you down certainly to a loss, overall loss. To reiterate again and again and again, deductions for FDII are only available to domestic C-Corps. They cannot be RICs or REITs. There is a haircut in the deduction that is slated to go into place for years beginning after December 31st, 2025, which reduces the FDII deduction benefit of 37.5 to 21 7/8. So in order to calculate the FDII and FDII deduction, there is kind of a multi-step approach that needs to be taken. As you can see down here in the corner, step one is to calculate the deduction eligible income. That is in effect taxable income of the C corporation. There are a few items which are excludable, but we won't discuss them for purposes of time here today. Step two is calculating the foreign portion of the deduction eligible income. In that case, you're taking your foreign sales or services, applying relevant cost of goods sold applied to those, and then allocating deductions to those sales and services, to the foreign sales and services, to come up with your effectively net taxable income that would be considered foreign. From there, you need to also calculate your deemed intangible income, as this foreign derived intangible income benefit is based upon this perceived return on your intangible assets. You calculate the deemed intangible income by taking 10% of what is called your qualified business assets investments, which in practical purposes is the average amount of your net assets held by your C corporation during the year. And step four, after all of that work, you can calculate your FDII, your foreign derived intangible income, and thereby apply your deduction percentage to see what deduction you ultimately will get. As an example, we want to walk through kind of the basics of the calculation for FDII, just to show how the benefit works out. You can see we have two columns here where there's no FDII benefit reduction, and the column on the right does show reduction in the benefit, just to illustrate how it won't drive you down all the way down to zero necessarily. So let's assume you've effectively calculated your taxable income. Your deduction eligible income is $2 million. You've gone through the process of looking at your foreign sales and foreign export services, and you could determine that 25% of your, let's just call it net income, would be foreign derived amounts. So 500,000 in this case. We've also calculated our qualified business assets, which would be effectively our net assets for the year at $1.5 million. So as part of that multi-step process, back at step three, we need to figure what our deemed tangible income return is. That is just nearly 10% of our qualified business assets. The 10% was set by statute as what I guess Treasury and the IRS and Congress would sort of deem a reasonable and rational return on assets. So what we do is we take our deduction eligible income, we subtract out our deemed tangible income return as a portion of that deduction eligible income, and that brings us up with the deemed intangible income. In this case, in this example, works our way to $1,850,000. Now we need to determine what portion of that deemed intangible income would be considered the foreign derived intangible income. So we apply our eligible foreign income ratio to our total deduction eligible income of 25% to the deemed intangible income to come up with our FDII amount of $462,500. At this point, we need to assess what our taxable income is. In column on the left, the primary example, we have ample as we determined deduction eligible income, or in this case, taxable income of $2 million. Thereby, there's no haircut in the amount of deduction is allowed. So we take 37.5% times our 462,500 to come up with our ultimate benefit. As you can just see, the difference amongst the two columns, and it's showing the reduction in the benefit, is net taxable income on the right is 2 million. We could presume that there would be an NOL or some other benefit that has driven down net taxable income. Otherwise, to bring us down to $200,000 in the column on the right, thereby reducing the amount of FDII that's eligible to be taken by 262,500, as that is the amount of FDII benefit that exceeds our taxable income. Taking 37.5% times the balance shows us with the reduced amount of deduction that would be allowed to be taken against our taxable income. Moving forward, we've kind of walked through some of the mechanics here, and looking sort of through the rules and into what is considered the foreign portion of the deduction eligible income. We're talking about sales and services that are made outside of the U.S. or for in what is in effect ultimate use outside the U.S. So in this case, it's any income that's derived from the sale of property. Sale is used broadly to include leasing, licensing, exchanging, or other some sort of disposition. You can see that foreign use is defined to mean any use, consumption, or disposition not within the United States. Qualifying foreign income also includes income derived in connection with services that we're discussing. So that'll be services provided to any person that is not located within the United States. There is no requirement that the property be manufactured in the U.S. And so that's kind of a benefit and a differentiator from the IC disc. You can see that services may be performed within or outside the U.S., but not in a foreign branch of a U.S. entity. Those sales are not allowed to be used in determining our foreign portion of our deduction eligible income. Lastly, the gross foreign sales and services income is reduced by properly allocated expenses, and so that works in a broadly sort of international tax basis of determining what portion of sales you have and what expenses are allocable towards those sales. In some instances, it'll be clear that those expenses are allocable towards just the U.S. sales, and in some it'll be clear that they're allocable just towards the foreign sales, and in some cases they are allocable amongst each, in which case you can use a reasonable method of either proportionate sales of each or cost of goods sold or margin or something along those lines to allocate those expenses which would be applicable towards both U.S. and foreign sales. And that's kind of where some of the nuance comes in this calculation. That's kind of the nuts and bolts of FDII. I know this is a very quick discussion on it. There is a bit more depth than we're offering here, but I think this provided a fairly high-level overview of what's happening with FDII, how you get a deduction, and what that deduction is. We should note, as Mark addressed earlier in his discussion about the IC disc, there have been some proposed changes with upcoming potential tax reform. Again, the situation is very fluid. I think there was new information released just in the last couple of days that may or may not contradict what we put on our slides here. But in effect, one of the items that was targeted as a revenue raiser was reducing some of the benefit for FDII it was accelerating the change in deduction from 37.5% down to 21 7/8 from 2025 to what would be effectively 2021 or 2022. But as more of a benefit to users or people taking the credit, it also would eliminate this this rule that the deduction is limited to current year's taxable income. Thus, any excess deduction would increase the NOL for the year. Somewhat of a sweeter change there. Further, some of the scope would exclude some income that would otherwise be considered what is called subpart F income and or QEFIN from PFIX that would not allow it to be used in the definition of deduction eligible income. So in the broadest sense, and coming up right on the hour here, I think we'll probably conclude our discussion today. I don't see any open questions that have flowed through on either IC Disc or FDII at this moment, but if there are any last minute questions, feel free to get them in and we can make our best attempt in the last few minutes, or at least get them on record, and we can reach back out should we need any answers.